Alan, Darby, Jaclyn, Martinez. This is the buyer's boardroom. Learn the most about who you are today and where you want to be after.
All right, back in the buyer's boardroom. How are we doing, Alan?
We're doing good. What's doing good? This is one of my favorite, not favorite topics, taxes.
Yeah, I definitely avoid you early April.
Good
Avoid asking for more money for anything.
idea. Good idea.
Not the
Yeah, no,
best.
it's an
Yeah.
important topic and one that I know that's near and dear to your heart.
Yeah.
So maybe why don't you set it up for us? Give us a little bit of
I
an
know, right? Living in a very high tax state, I think, it's
overview.
on my mind all the time. It's certainly on our sellers' minds, and everyone wants to minimize taxes, of course, and especially on big transactions like this, you want to make sure you get it right. So thought we could bring on tax counsel that I have worked with on a few deals, but is a tax partner at Kilpatrick Townsend. So
Awesome.
as you
Yeah,
know,
we'll get some great advice on the buyer's boardroom today. So
yeah, so we talked through like some examples of interesting things that we've gotten to work on together. And I think the theme of it is every situation's unique. There's really some misconceptions and pitfalls that I think we could get into before we hop over to the
yeah.
guest. Yeah.
There's got to be, like you said, you started with the punchline, which every situation truly is unique. Obviously, you need your own tax advisor involved here, and you can give your opinion on when the right timing of that is. But what would you say are maybe some general? Of course, we're talking about selling your wealth management practice, and there's going to be tax implications in doing so. But what would you say are some of the thoughts, whether they be true or misconceptions, that advisors start the process with? They like have an assumption that it's going to be this way. What are some of the big things that you see?
From a deal structure perspective, there's often the assumption that it's going to be a stock purchase
Okay.
and not necessarily that the advisor is wanting their RIA to continue. Usually they're happy to wind that down and everything, but there is that assumption, and maybe it's coming from their CPA that is a better outcome for them, or something like that it would be a stock deal. But the reality is that most buyers in the space, they're very focused on doing an asset purchase, um, lifting the assets into their RA
Right.
entity, and a number of things that come along with that. But that's kind of the foundational element for probably 99% of the deals out of the, over 100 that we've done. I think maybe three
Yeah.
have been,
I was trying to think back of
yeah,
who these might be,
really
and
little.
it's
Yeah.
definitely in the very, very small percentage column. Um,
Hmm.
what are just generally speaking, what are some of the reasons that they prefer an asset purchase over a stock purchase? The buyer.
I think, yeah. So part of it is the ability to amortize the purchase over 15 years. So the majority of the purchase, they're able to amortize that out. And so that helps them year to year on their accounting.
Right.
From a liability perspective, it's with a stock purchase, the buyer is inheriting all of the known and unknown risks that the business might have.
Right.
And with an asset purchase, all of that stays with the seller. And they're only assuming certain liabilities that are listed out.
Got it.
And so with a stock purchase, it could be theoretical risk, it could be an academic exercise, but usually things don't pop up after the close,
Yeah, you
the
never know, and that's the
but you
point.
never know.
Yeah,
Yeah.
yeah. So the buyer, and when you say it stays with the seller in the asset purchase form, it stays with their former entity, which
Hmm.
I think they keep open for a period of time post acquisition, and then ultimately end up winding that down in most cases. Wouldn't you say, or is that?
Yeah. Yeah. Like usually payments are spread out over a number of years. And so it's usually stays open as long to receive all of those payments. And then depending on how the equity is issued, if it's issued to the entity, you may need to stay open until that buyer's equity liquidates
Okay,
well into the future. Yeah.
okay. So they may end up
Yeah.
keeping that entity open for a while then post.
It could.
Yeah.
Yeah.
Okay, here's a question that I know I get asked constantly. So maybe you can shed some light on this. When I sell my business, In generally, how are the proceeds taxed? And is the taxability of the proceeds, does it change based on the nature of consideration? For example, if I took cash versus equity in the transaction, what do you, I know again, it's always with the asterisk of, seek your own counsel and every situation is unique, but in general, how are the proceeds taxed in most transactions?
Cash is usually more straightforward. So that would be as you're receiving it in that tax year, it would be taxable that year. And so when there's payments that are spread out into the future, just as you receive each wire, then that year it would be taxable. And then, the split between what part is capital gains versus ordinary income, which is usually a small percent of the total, that's all agreed to with the buyer as well. So in
Okay.
that taxable year, you could, you'll have that split as well.
Cash in general is going to, the majority of it we would expect, and the vast majority of it,
Hmm.
under the asset purchase structure that we just talked about, you would receive long-term capital gains tax treatment in the year that you actually receive the payment. So you
Yeah.
might have a closing payment, so that would be taxed in that year. You might have a retention payment that would be paid a year or two from now. It would be taxed in that year. And your expectation is that the vast majority of that will be long-term capital gains. Okay. All right. Now
Yeah.
you want to talk about equity. How is that typically handled?
And then equity is really interesting, so I would say the majority of deals that we're working on, the common goal on both sides for the buyer and seller, and they're really aligned on this too, is that the equity, the taxes on the equity received are tax deferred until the ultimate liquidity event. We're selling off those shares in some sort of event. Maybe it's a recap, maybe it's a liquidity program that the buyer is offering at a more enterprise level for all of the shareholders, something like that. But when you receive the equity at the closing, it's generally not a taxable event and just deferred until it liquidates.
Okay. And that I'm sure is very buyer specific in terms of how they've structured their
Totally.
acquisition model. And I know we've gone deep, deep down the rabbit hole of that conversation with tax counsel, accounting firms, when the ability to defer the tax was brought into question. Um, that indeed ended up being the outcome.
Hmm.
It took a lot of hours and cost to get to those results, but that's that. So for people who are listening, we would on average expect that any amount of the consideration you took in equity would indeed be deferred. You wouldn't have to
Hmm.
pay capital gains tax until that there was a liquidity event, ostensibly many years down the road. So
Yeah.
okay.
I will say, it's not always though, right? Like we had a deal recently where a huge portion of the equity was taxable at the closing, and the sellers are young and wanted a large equity roll. And when we factored in the taxes on that equity out of the cash position that they were receiving as well, there were very little like net proceeds after it, but it was what they wanted, like for other
We wanted to
unique
establish a
tax
basis for that.
reasons. Yeah. But
Yeah.
it's really a mismatch of when you're getting the value of it and paying the taxes. But I guess if you believe like tax rates are only going to keep rising, maybe it is better to get it out of the way. And that was kind of part of the reason for these sellers. So yeah.
Well, it's never a dull day in IRS land. So I know.
Right.
Thank you very much for answering those general questions. I think the meat of it is going to be with our esteemed guest that I know you interviewed, and so everyone enjoy that. I think you're going to find it very deep. I always say if you're interested in things like this, you'll probably get a lot out of it. If you're casually interested in it, it'd be great to put on at like 10 o'clock at night when you're trying to go to sleep. Instant snooze. So,
We'll jump to it.
all right. Thanks.
We're so excited to have special guest on today, Elizabeth Guidi. Thanks for coming on.
Hi, thank you so much for having me.
Yeah. So, for all of our listeners out there, Elizabeth, she's been a huge resource for me on numerous transactions over at Kilpatrick Townsend, which is a big law firm. She's based in New York, and her practice really focuses on all tax aspects of a transaction. So, mergers, acquisitions, a lot of private equity fund formation. I also noticed you were recently recognized as a New York Rising Star in 2024 from Super Lawyers Magazine. What a cool magazine. I didn't
Thank
even
you.
know that magazines were still printed, but that's great.
Thank you.
Yeah, that's amazing. Well, cool. So for our session today, really just want to focus on all the tax considerations, as you know from your day job, of course. Everyone's trying to limit taxes that they pay, and from our seat at Alaris, it's um, more about setting expectations and helping both sides really like be prepared to ask the right questions, because there's so much nuance in it, and just being able to ask the right questions to really sort out each seller's specific situation, how it may look for them. So excited to get your perspective on that.
Thank you so much. And yeah, I'm really happy to be here. And generally, my theme will be to consult your tax advisors early and often.
Yeah, I know. When folks want to bring in their tax advisor like before the LOI, I'm just like, thank goodness. Better to know early and help shape things from the start.
Absolutely. Absolutely. Whenever I get a chance to weigh in on an LOI, I really appreciate it because if something's incorrect in the LOI or, it just creates confusion, and that's
Mhm.
the worst. Or I guess the best case is it creates confusion. The worst, it can create problems.
Right. Yeah, definitely. So, and for our listeners too, being so focused in the wealth management space, maybe from your perspective, like what's the more typical deal that you're seeing in the wealth management space? Is it more of asset purchases or stock?
It's definitely more asset.
Mhm.
Occasionally you'll see an equity deal, but for the most part, it's asset sales, and there's a couple of reasons for that. Um,
Mhm.
and those include, for example, a lot of people in this space who are sellers actually, they're not owners of an entity. They just have their own book of business. They're not an employee, and so um, generally that requires asset sale treatment. Really, when you think about it, because there's not an entity to buy.
No entity to buy. Yeah. And you think about like our national buyers in the space, they already have their entity. There's usually no need to have, if it is an independent RA, to have that continue from a compliance perspective. It makes sense to blend everything together. Um, so that makes sense. And then I would say too, just as to shape the conversation today, I think most of the sellers that we work with, they are, it's a small founder group, usually, five and under owners on the team. And they've generally grown the business from nothing, many years ago, haven't really grown through acquisitions. And that's more of the profile that we work with and that our listeners are too. Um, Perfect. Okay, well, let's just jump right in. So we talked a little bit about like most common deal structures. So definitely asset purchase. When are stock sales more appropriate? Like when do you see that come up?
I mean, for example, if the seller is, in a corporation or an owner of a corporation, if the buyer is a corporation, and the seller obviously would have to be. So, that's generally speaking, you see a stock sale, when there's a corporation or, you might see a partnership equity, for example, sale. Um, and very large RIA transactions also, oftentimes their consolidated group, and they just want to acquire another entity in their chain of ownership and kind of keep maybe the business is siloed, separated. It's really kind of depends, I guess, on buyer's profile,
Mhm.
and that could cause an equity sale rather than an asset sale.
Okay. Those are definitely more rare. And so going into it, most likely knowing that it's going to need to be an asset purchase. And if the seller wants a stock purchase, like I guess my guidance would be to get that on the table early and make sure that's really solving the business concerns that the seller has before getting too focused on it too, because it may really limit the buyers that are interested.
Absolutely, especially in this space. And so you kind of want to be market, you want to be commercial. And obviously if you have extenuating circumstances, be aware of them. Kind of this is where, again, I'm going to call in the advisors. If you're planning on selling your business, you should understand your profile, your tax profile, so that you can fight for what's important and you can let go of what's not. Because a lot of times, in negotiations, I'll end up, either not having facts, or I have the facts and the other side doesn't know the facts. And so, we end up disagreeing about something that's actually moot. It's like, doesn't
Uh-huh.
matter. Yeah. So, that's why facts are everything. When you come with facts, you're best able then to negotiate the best deal for yourself.
Mm-hmm. That makes sense. Okay, so maybe focusing for a moment on the more common structure I'm seeing these days, and I think a lot of it has to do with the private equity backing of most of the acquirers in the space, would be an asset purchase, of course, but then we're also contributing assets in exchange for some rollover equity partnership interests in the buyer's entity, as well as part of call it maybe 20 to 40% of the consideration being in those types of units. And then the goal typically that both sides want is that portion that's taken in the rollover equity, that it's tax deferred until it's liquidated down the road, not knowing when that would be. How does that all work? And maybe is that what you're seeing too? Because that's been more of my experience. Yeah.
That's exactly the same. Usually the buyer wants this advisory business, and therefore it wants the person, because we'll talk about personal goodwill a bit, but that's generally so buyer wants them to take ownership in buyer, because buyer wants them to grow the business and be the point person, the person with the relationships and whatnot. So yeah, usually there's what happens is, let's just pretend it's an independent advisor. They contribute an undivided, and this is where I'm getting a little taxi here, an undivided interest in all of their assets is the step one, in exchange for a partnership interest. And then the buyer subsequently purchases the remaining undivided interest in all the assets, so that it ends up holding, 100% of the assets at the end of the day. And then the seller's benefit is that when it contributes the assets into that partnership in exchange for a partnership interest, that's where the tax deferral comes in, because under Section 721 of the code, when you contribute an asset to a partnership in exchange for partnership interest, that is generally tax deferred.
Mm-hmm. Okay, you just threw out some tax code. I love it. 721. Right. But that is, and we'll see that referenced in the purchase agreement. That is what everyone is operating off of. That's the goal. And then just to double click on that, the goal really in there for the seller is that portion of the purchase price, call it 20-30%, that's not taxable then until a future liquidation event, probably in line with the next recap of the private equity firm that's backing the buyer that you're now joining. It's usually tied to an event like that, or some sort of liquidity event.
That's right.
Okay.
That's right. And that's, that's why some buyers may want a taxable rollover, which is also a possible structure. And again, depending on seller's tax profile, it may be amenable to that. I've had situations where it turns out that the seller has tax assets and they can absorb the tax hit, or enough cash, whatever the situation may be. But the benefit of a taxable roll is because when you do a tax-free roll, a tax-deferred roll, you have a carryover basis, right? Your partnership just carries over in its basis. If you do a fully taxable roll, now you have a partnership interest, fully stepped up to the purchase price. And so on a future recap, for example, you have the basis to absorb, that distribution of cash. Because if they do a future, some sort of liquidity event, like a recap, and you don't have the basis to absorb that, then that's going to be taxable to you. So, these are the kind of games that you can play, because again, in certain situations, seller may be absolutely fine with a taxable.
Right. I had that recently, actually, when we got to work on together. Yeah. And it was very interesting. And their perspective was around, okay, if the general belief as well, on top of what you're saying about basis, is that tax rates are likely to just keep rising, right? And better to get that out of the way if we can afford the tax burden at the closing, which depending on the allocation of the purchase price to this taxable equity receipt, we have a major mismatch of cash being received and taxes due. And but overall, that was the right outcome for them with the other factors that they had in play.
Right.
And so very, very interesting. Yeah.
Yep.
How does the taxable part of the purchase price, non-taxable, how does that relate to capital gains tax versus ordinary income taxes? Are those, do you think of those being related, or how do you think about that?
Yeah, they are, because so what happens in an asset sale is the purchase price has to be allocated, and among there are 7 asset classes, and some of them trigger ordinary income events. For example, inventory, accounts receivable, also certain, a covenant not to compete may be ordinary. This is why it's important to consult your advisor, because in some cases it may be cap gain. And again, also, when personal goodwill is involved, really understanding how, the best way to prove that that's personal goodwill. And not, for example, if you're an employee of a company, it's maybe harder to say it's your personal goodwill. Whereas if you're an independent contractor, it's easier. So, those kinds of, to try to work before the sale to minimize the company goodwill and to emphasize the personal goodwill.
The personal goodwill. Okay, that's a good tip. I like that. Do you often see, so I guess going back a moment to the tax deferred equity granted in a transaction, do you see a common holding period in order to achieve that deferral, or a period of time where the seller would need to hold the equity before a liquidity event could happen in order to preserve the treatment?
That's a great question. And actually, for one situation here, we actually don't have a holding period requirement, because in a tax deferred roll, everything is just carried over. So even if you have a partnership interest and you haven't held it for a year, it doesn't matter, because you're exchanging a partnership interest for a new partnership interest, and that holding period of your old one just tacks on.
Oh,
So
okay.
because it's not a taxable event, there's no holding period. If it was taxable, you'd want to have at least a 1-year holding period to ensure capital gain treatment.
Capital gains treatment.
Long-term capital gain. It would still be capital gain, but unfortunately, short-term capital gain is taxed at the same rate as ordinary income. So,
right, if it's not held for the year. Okay, that makes sense. And then in our, I call it our plain vanilla structure. So we have, some portion of, in a typical transaction, some portion of the purchase price is received as cash at the closing. And then usually, to call it 20 to 50% of the purchase price may be paid in cash at future dates based on retention or growth milestones, things like that. And then we have this equity piece that could be taxable at close and could be deferred, and it just depends and that sort of thing. But as far as the cash components, when are those generally taxed?
if and when received, right? So, clearly on the closing date, when you get the purchase price, any cash involved is taxable then.
Mhm.
And then earnouts are generally taxable if and when received. You have to meet. There's nothing guaranteed about them. And that's one thing you want to be sure of, right? That they're not just a guarantee, because that could change their treatment. But generally, earnout is also, taxed as goodwill, because after all, if you, made these, requirements, then that's generally just allocated to goodwill. Again, though, if, for example, an earnout is tied to employment, then that's considered comp, and that's ordinary income. So one of the things you kind of want the earnout from a seller's perspective, to be tied to EBITDA or some kind of economic measurements, rather than a promise to stay employed for X.
Mhm. Yeah. So that would be a big red flag, you're saying, if certain payments are tied to the person technically needing to be there, even though it's, of course, implied the business may not achieve the hurdle if the person isn't there, but having it be so explicit about that and not just about revenue retention or EBITDA or something like that, something economic, then that gets into a zone where it may be ordinary income. Very interesting. Okay.
Yeah.
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 Yeah. I love that.
I mean,
Okay.
there's authority that says, maybe it's still cap gain, but it's walking a fine line,
Mhm.
situation.
Perfect. And do you often find that sellers and buyers are on the same side of the table of wanting something to be taxable? Like in that example, the earnout, where it's, um, you know, like sellers going to be want that to be a capital gains treatment. Do you often find the buyer also wants that to be treated as a purchase, or are they aligned?
I do find that because, again, buyer is excited about this acquisition. It wants to have this person come over and be a part of its team. So it kind of has an interest in, pleasing that person.
Mhm.
So generally speaking, the buyer's amenable, I mean, there's always situations where like it's tied to employment, but, I would say that's very rare. I don't,
Mhm.
I don't see buyers insisting on that.
Yeah, same. Okay,
Mhm.
that's good. Yeah. Okay, perfect. Well, switching gears a bit, I mean, like the sellers that we encounter, I would say most of the time it's LLC entity or the personal goodwill situation. But I guess sticking to entities for a moment, we have LLCs, C corps, and S corps. Um, like how, and I would say generally on the buyer side, it is an LLC. Um, how are you seeing the taxes differ for seller? I know that's probably a very loaded question, but like in those situations where buyers and LLC, we're wanting to do a rollover equity transaction, like what should like a C corp or an S corp be thinking about, that sort of thing?
That's a great question. So just to describe LLCs from a tax perspective for a second, they're very flexible. An LLC just formed by one person is something called a disregarded entity or one entity, a corporation that forms an LLC subsidiary. That's what that means is disregarded is the activities of the LLC would then be reported by the corporation. The LLC itself is not a federal income taxpayer. It may have state and local taxes, but it doesn't pay federal. But if an LLC has more than one owner, it automatically becomes taxed as a partnership.
Mhm.
However, you can also make an election, whether it's singly owned or owned by multiple members, to treat it as a corporation. So
Mhm.
that's why it's the most flexible entity from a tax perspective. As a tax lawyer, I'll still tell you that I prefer, if you want to flow through it, to be a partnership,
Yeah.
and if you want a corporation, form an Inc. Because, if you forget to check the box on an LLC, that can lead to adverse tax consequences.
Mm.
So I always get nervous about elections, I don't know, it fell on the floor, I forgot to mail it, no, IRS never
Yep.
got it or something. But that,
Start a new
and that
life. No.
doesn't happen.
Yeah.
Those things happen. Uh, so that's one thing. Now let's just say this is an LLC taxed as an S corp on the sell side. A lot of times, what S corp owners don't realize is that that rollover has to actually happen through the S corp. The S corp contributes the assets and receives
Mhm.
the partnership equity, and it really can't distribute that partnership equity out without a taxable event for its own.
Mm.
Now, again, maybe owners have a ton of basis. Maybe there's some sort of losses that are trapped there. Usually, S corp owners don't want that. But again, I've been on a deal where they did.
Mhm.
So that's an interesting point. If the LLC is taxed as a partnership, that's again easy, and the partnership is most flexible, right? You can contribute those LLC interests into buyer's entity and distribute them up, and generally that's may or may not have that when the partnership distributes, you would know your basis as in your interest and whatnot, and probably it would be able to be distributed out and up without adverse tax consequences. Hopefully, anyway, it
Mhm.
could be a taxable gain, but maybe you can absorb that. And then if the seller is a corporation, I'm going, I guess, through sell side entities first. I can talk about buyer
Yeah.
entities next. But again, interest fine, but again, this would be a situation where most likely it would be an equity sale, unless again you would have to roll through the corporation, because it's the kind of the same issue with an S corp. Once the corporation receives the rollover equity, it can't really distribute that out without a taxable event, and except with, again, exceptional circumstances. Usually. So the sell side entity matters. Like, for example, a partnership can distribute the assets up to the individual who wants to roll. Maybe there's only one partner, right? And the partnership, the LLC tax of the partnership offers the most flexibility to like allow a personal, the individual to end up owning the buyer equity, whereas S corps and C corps, it may not be possible.
Right. Yeah, that is a common goal I see, where they want to be able to close down that old entity. It's no longer really being used. They don't want to, just all the ongoing things that you need to do for an entity and move it to person. But sometimes that's just not possible, really. Or I mean, it's possible, but it would have adverse tax consequences of it.
One thing for an S corp that it can do, if you want to the S corp can sell its assets. And if it liquidates within a year, and therefore then the individuals get those partnership interests from the roll, that is actually good for S corp owners too, because they get that's just treated as a stock sale from their perspective, not as an asset sale. So they get sell a stock as capital gain. So they like that, but again, that requires the S corp to liquidate within a year. And sometimes with earnouts and things like that, that may not be possible. There are structures to work around this, but they're complicated and really dependent on individual facts.
Okay, and then Elizabeth, when it comes to the code, then for when sellers are a partnership versus a C corp or an S corp, how would you describe how the parts of the code tie in then for the taxation there?
Right. On the sell side, it does always matter, again, what type of entity you're talking about. And there's different consequences. A partnership, an LLC tax as a partnership has the most flexibility to distribute out assets, to distribute cash, things like that. Generally speaking, distribution of cash, liquidation proceeds is tax exempt and up to the extent of your basis, and then taxable again to the extent of your gain. Then, for example, though a C corp or an S corp, when a C corp distributes money, it's after a sale, with sale proceeds from an asset sale, that's generally going to be taxed as a dividend, which, to the extent that there will be earnings and profits, for example, from the asset sale. And so that distribution, that's taxable both at the corporate level. And this is the important thing to recognize, that, there's always a double layer of taxation on corporations. So they have to, one, the corporation itself will pay tax on the asset sale. And then two, the shareholders will pay tax when the cash is actually distributed out to them. And, that, again, generally taxable as a dividend, which is a preferential rate for U.S. persons. That's basically the same as a capital gain rate. Dividends only, their taxation begins to be different if you have non-U.S. members. But that's generally not the case in these types of sales. And then in an S corp also, again, S corps are flow-through entities, but they're a little more tricky than a partnership. So again, partnership being most flexible, and a corporation having that double taxation on the two ends of the spectrum. And then the S corp is somewhere in between, because yes, S corps are generally flow through, but because they're not partnerships, there are special rules that apply. And so it can affect the S corp itself, adjustments and accounts. And even if the S corp is not a taxpayer itself, it can impact the tax once it's distributed, and the taxable amount once distributed to its shareholders. So it's always, just important to understand, again, the company's tax profile and how distributions will be treated.
That's interesting, because I guess I always have thought about it as the C corps that could have the or will have the double taxation, but but S corps too. So that's
they can
to walk through. They can.
Or can affect the taxability of their members, the type of sale. And again, if an S corp were to distribute out property, like try to distribute out the assets prior to the sale, then that would be taxable at the S corp level. The distribution of cash versus distribution of property, other than cash, can have different tax consequences for an S corp.
Mm-hmm. And what's unique then about if there's like a rollover equity component for an S corp? What should we be thinking about there?
Right. So again, it would be the S corp that does the roll, generally speaking, in order to preserve the tax deferral. If, on the other hand, the S and so then the S becomes the partner in the buyer partnerships, not the individuals. If the individuals want to directly become members, that may be taxable for S corp holders on the distribution of the partnership interest, or the distribution, alternatively, a distribution of assets up and out prior to the sale, so that the individual can directly contribute assets. In both of those cases, that has tax consequences for the holders of the S corp and the S corp itself.
That's great. Well, yeah. So I'm hearing, there's flexibility. There's some things can be done. It's all about getting the goals out on the table, and then really like kind of flow charting through what's happening where, and sharing that with buyers so that we're on the same page of the intent here and the goals. And from like a practical perspective, we're working on a deal. Like, let's say we have a seller that, any entity should get tax counsel advice, but how does that typically play out where you're engaging early stages with buyer and seller to explore that? Like, what are the typical steps there to make sure that everything's kind of set up correctly from the beginning?
Yeah, that's a great question. It's largely tax diligence, and this is the importance of tax lawyers and accountants working together on the sell side. Sometimes clients are hesitant to connect us, but it's very important. And I would also say, I've dealt with some sellers who, again, maybe just own their own book of business. They have their personal accountant, but, not really like a business savvy accountant, And that when you're selling your business, it's important to consider, maybe I need a different accountant with different expertise, because I found that working, with some great accountants, but like they're not familiar with selling, so sometimes I'm explaining things. So it would be great. The best idea is to have a sophisticated, deal side accountant and tax lawyer working together. So, because generally how it works is accountants sign tax returns, right? They're familiar with the tax profile. And so the lawyer can come up with theories, with ideas, and then that's proven out by the facts of the account that the accountant has. And that's why it's really the best friendship of all, because when I come to negotiate, when I come to draft, I am armed with facts. And so I can shut down, debates that don't matter, because I say,
right.
I've got the facts, and that often is that's a very successful way to negotiate, I find.
So getting everyone talking earlier is always helpful. And that makes sense. You're not that you're like someone's CPA that, has worked for years and years for just all the normal business accounting. This is a different animal, and it doesn't mean that they go away necessarily, but just to get through the transaction, just need a little more support here, and worth the resources to invest in that so that there's no surprises later. What kinds of tax mistakes do you think sellers make in this process, likely as a result of not, linking everyone up early? But what kinds of things do you see happen?
There can be real disasters. So I have, and sometimes it ends up working out, of course, too. But right now, I'm actually having to go to the IRS to seek a private letter ruling, which is a very complicated and expensive process. And the reason is the client got into negotiations, asset deal, client's an S corp. In an asset deal, it really shouldn't matter if there's S corp problems, because again, you're only buying the assets, you're not buying the entity. Somehow, the buyer said, "You have problems with your S corp," and I'll talk about problems with S corps in a minute, because they're very common.
Like, what are those? Yeah,
right. And in fact, we won't close until you go get a private letter from the IRS.
Oh goodness.
And I'm telling you, so first of all, again, as a lawyer, I'll just tell you, private letter rulings are you're coming to the IRS, you're asking for relief. That means totally open kimono. It's basically an audit. You're going in and begging them to audit you, and you're asking for relief. And so the legal fees end up being almost over $100,000 when all said and done. Because again, you can't. This isn't just some little flim flam memo or anything. This is like the best legal writing a lawyer can do, highly dependent on the facts. And getting to know the client very well, because I'm going into the IRS and representing them, so I have to be able to answer questions, and the client comes in too. But nonetheless, we always want to be on the same page. So, and again, it was the client had agreed to this private letter ruling before I even came in, and so it was impossible to negotiate against it. It was already a done decision, and so that's something to be. That's why you don't want to like focus on non-tax issues at first, even though there may be many of those. And I understand the focus, but you still want to keep tax in the back of your head.
Wow. Yeah, that's different for sure. And I would imagine anything like that would take a lot of time too. So now your deal's very delayed.
Absolutely.
Yeah.
Because it's been hard. We've had to amend returns as a result. We've had to do these things. It's been taking a lot of time to get that work done. And then the IRS is just, very slow right now. And so it compounds the issue. Yeah.
Perfect. Yeah. Okay. That is good. What about do you ever run into anything like state specific taxes? Like how do you get ahead of those types of issues?
That's another great question. If the seller's an entity, for example, or a person in an entity that's a pass-through, an S corp or partnership, a lot due to the SALT cap limitation, which is a state and local tax, the deductibility of them is limited. I think I know it was 10,000. It's with the big beautiful bill, it's gone up to 40 in certain circumstances. If you phase out. So it's not ideal. And so the workaround is that states have high tax states, like in New York and California, have enacted PTET, pass-through entity tax statutes, where your partnership or S corp can elect to pay your state income taxes on your behalf, and then you kind of get a break because it's at the entity level. It's like, instead of you personally being subject to that $10,000 or $40,000 cap, it's not capped because the entity is on your behalf. And that's a very interesting thing because, for example, I'm on a deal right now. Again, it's treated as an asset sale for tax. And usually when a deal is treated as an asset sale for tax, sometimes the seller will ask for a gross up, because if the seller is an entity, because again, it could get cap gains on the sale of its equity, on the sale of its assets that may have more ordinary items. And so it will say, well, I want to be grossed up for the tax consequences of asset sale treatment, rather than equity. And turns out with this pass-through entity tax election, there's a lot of times no gross up. So before that, before the PTET, I would almost always see a gross up asked for. And now it's rare, especially in these high tax jurisdictions, because that offers a lot of benefit to the entity. And to
that's huge. Yeah.
So that's something definitely to consider. And then there's also, you never know, like, are you being compliant? Does the state you operate in impose sales taxes on services? Technology, whatever it is, you want to make sure that you're up to date on those filings and that there's no controversies, because again, that could raise deal issues.
I love the point you're making about the caps on the state specific ones, because it goes to your overall theme here of make sure you're focusing on the things that really matter. You could burn a lot of calories on these issues where, because of your setup, it really doesn't matter. You can rely on the entity side, on the federal side of it, and get those benefits. And rather, and if you're focusing there and it really actually doesn't matter at the end of the day, you could have used that bargaining power for something else that really does move the needle for you. So
absolutely. Tax is just another asset in a deal, when you think, or a liability. And so, it should be, when you're smart on tax, you can, to your point, you can horse trade, you can start saying, oh, that environmental liability, maybe I won't ask for a gross up, but you're going to take that on, or the like, and that can be persuasive in a deal.
Yeah. Perfect. I know when we were prepping for this, you were talking about the like anti-churning and pre-93 businesses. What do those words mean? Tell me, what do we need to know about that?
Yes, it is fascinating because anti-churning is a provision in the code that talks about if it's a pre-93 business and the rollover is over 20%, then anti-churning may prevent buyer to be able to amortize the goodwill long and short. And so I don't think when this was enacted in 1993 or 1991, whatever it was, that anybody expected it to still be applicable in 2025. So it's a real kind of thorn in the side. And it's just something did you inherit this book of business from your father, your mother, from your uncle? Was anybody related to you? And related is very wide, did they give it to you prior to did they develop this business prior to 93? You need to know that because it's going to be one of the first questions a buyer asks. And it's the best thing when you can answer this business started in, 2015 or whatever, anytime after 93,
Right.
Because that just can be, and again, there is structuring ways around anti-churning, but again, it's like the more entities always my advice is always try to keep your deal as simple as possible, right? Like the more steps in a structure, the more entities you have to create, this is the more room for somebody to make a mistake, and so yeah.
That makes sense. I'm kind of running through the list in my mind. And I mean, so many sellers that we work with, they've been in the business for decades. And like many of them founded in like 80s, early 90s, and, have grown it from, and then not understanding then, okay, there could be implications here just because of that.
Absolutely.
Yeah.
Absolutely. Yeah.
Interesting. Okay. Perfect. And let's see, maybe one more question here around, we mentioned a little bit around the different asset classes. We're allocating the purchase price across the different ones. Typical wealth advisory business, there aren't a lot of fixed assets, inventory, that sort of thing, right? This is all client relationships. But you mentioned on the non-compete, the portion that's allocated to that, and that would sometimes, of course, be ordinary income. How are those percentages derived, and like where do you typically see that falling for assigning the purchase price to that?
Usually, especially on the sell side, I advise parties to agree on a number up front. Like a lot of times the way the allocation works, because the way, like, for example, purchase works generally is, again, on the closing date, you get paid. But these, the components of the purchase price haven't been finalized. Like, right, there's usually an adjustment for cash, debt, working capital. And so you kind of, within 90 days of the closing or so, you kind of finalize the numbers. And so only after that can the stuff be allocated to everything, the purchase price be allocated among the assets, because that's when However, even at, before signing, even, the schedule that's produced at the end is just a methodology, class 1, fair market value, class 5, net book value, whatever it is. Though in class 6, which is where the covenant not to compete sits, and or a customer list, they might agree, this amount. And generally I see 100,000, if the large purchase price, you see some amount that's not, nothing, but it's also not like crazy, and so again, like accountants have, they have tools, and I wish lawyers did, but we don't, but they can tell you, like kind of, they have market profiles and, ranges of amounts, market amounts. And so they can advise you on what a market number would be. And so that's like an important question to ask them, because you don't want to agree to too much being allocated there, especially if it's going to be tax exempt. But, you have to accept that it's going to be some amount.
It's going to be something. And yeah, that makes sense.
And again, your accountant could advise you on the enforceability of the non-compete in your state. What are the time limits, the parameters, all those kind of factors can matter in its tax treatment. So, that's, again, something factual based.
To step through the specifics. Okay, perfect. Well, this has been good. It's so fun to kind of step back and be more reflective on just all the learnings of your career. Um, Maybe just to sum it up for our listeners, like top 3 to 5 things sellers should do right now. They're thinking about a transaction, or maybe they're close on an LOI, and they're thinking to themselves, okay, what can I really take from this? I mean, I'm definitely hearing link up your CPA, but also start working with your deal counsel. And if they don't have the tax expertise too, then bringing in their partner that also has that, so that everyone's on the same page. And maybe even your estate planning attorney too. If there's specific goals there to get things into trusts and that side of it, getting all the goals out on the table early.
Absolutely. Look, you're selling your business. I mean, congratulations,
Yeah.
right? So this is a huge event in your life, maybe the biggest one. And absolutely, you want to plan at that point with your trusted estates lawyers, your estate planning, and definitely your CPA and your tax counsel. It's imperative, and it can save you so much money. It can save you so much money. So
Yeah.
that's important. Yeah. I would say, some other things I would recommend is, again, know your tax profile. Do you have some specific tax asset where you may be more comfortable with a taxable transaction versus non-taxable? That often, is very pleasing to both sides, when because again, by the way, if you have a fully taxable event, you have step up in basis on a future sale, you have less gain, there's a lot of benefits to it. And also to ascertain where you can be flexible and where you need to be inflexible. Um, and, you know, um, if you're an S corp, I mean, any entity, have your papers in order. Like I said, make sure your state filings are correct. Make sure you're up to date on even de minimis things. And if you're an S corp in particular, ensure that you've been compliant so you don't get in the situation like I'm in with the PLR. Because that's just, ask your accountant, hey, take a fresh look at my papers, look back at my history. I want to know that I'm not going to have any issues raised. And just, if you want to do buyer, if you're a buy side, I would say have clear vision of what you want, you know, and then both sides have to be flexible because facts come up and it can change things dramatically.
Absolutely. I know we did focus quite a bit on the sell side, but it's so good. There's a lot of, I would call them aspirational buyers out there. They haven't done a transaction yet. They want to begin their acquisition program, and as much as that's important to have your purchase agreement ready to go, all of the sections that relate to the like legal and tax deal structure parts of it, to have that really locked down. Because like, as I've noticed, even in very early conversations of talking to sellers, random questions will come out that the seller may be trying to, if they've done their homework on their side, where they're trying to understand, okay, would this buyer be open to a stock purchase? Would they be open to, other features like that? And if you haven't really thought through those things, it can be hard to unring the bell too. And maybe, they were open to it, but maybe from the standpoint of not knowing the implications of agreeing to that.
Exactly. Yeah. Yes.
Perfect. Well, thank you so much for taking the time today, Elizabeth. It's been educational and fun to refresh on all of this part of it. And yeah, we'll see you soon.
It's been a pleasure to be here. Thank you so much for having me.
All right. Well, Jaclyn, fantastic interview. I learned a lot from that. I thought I knew everything, but obviously I don't. So well done. I'm sure everyone who was listening to that got a lot of it as well.
Thanks. I appreciate it.
Yeah. All right. So I think we have time for a question in the mailbag. Do we have anything today?
We do. Yes. So let's see here. Dear Buyer's Boardroom, I recently signed an LOI with a buyer and am thinking about all of the implications of EBITDA changes as it relates to my purchase price as I go through the next steps. And there's an employee on my team that I'm not sure they're really a long-term player. How do I decide if I should cut them now and approach the buyer about an EBITDA increase, or navigate the situation?
What a really good question. And this is actually something that comes up quite a bit, when you're going through the valuation process and you're looking at trying to maximize valuation by getting as operationally efficient as you can. You're looking for expenses that might be redundant or could be removed from the P&L before, you get the offer from the buyer. And the biggest line item in your P&L is staff, right? And so you're often looking very hard at personnel. And let's face it, it's a very sensitive topic for your team. Most of these people are wonderful, been with you for many, many years. But the reality is there is likely going to be some opportunity for headcount reduction. It's always seller driven. I want to point that out, as I'm sure you would agree, Jaclyn, that usually it's never the buyer coming back and saying, hey, we think you're overstaffed. We need you to lose these people. It's usually a personnel decision made by the seller where they have said that, hey, this person or this role may not be necessary in the future, or can I repurpose that person into another role? And if they can't, then maybe the better idea is just to remove them from the P&L. Whatever they were being paid and comp, that drops right down to EBITDA, and they get a valuation on that savings. So that's the gist of it. But the thing that strikes me about this is that they're already, did they say it's signed an LOI?
Yeah.
Signed an LOI. Okay. So the buyer at this point where you're getting to LOI, they've probably already done a review of the staffing, roles and responsibilities, who does what. I don't know if they've come to the same conclusion. Here's something that I would definitely encourage a seller to do is during the process, the period of time you're working with the buyer ahead of the LOI, any comments, concerns like that about staff, you want to get on the table early because you can imagine the buyer's perspective here. They think everything is agreed to financially, staffing wise. We've signed a letter of intent. We're now in this post LOI workflow. And now you're bringing this back up again. It may come across as just trying to increase or bump valuation by slashing staff. If you haven't already brought this to their attention before, I think it would be perfectly fine if you had raised that issue with whatever staff person prior to the LOI. And maybe there was uncertainty about your actual feelings about it, and so you just kept that person in the P&L, and therefore the offer was tendered with the assumption that they would be there. And now maybe something's happened. Maybe you've had a personality conflict, or you've come to whatever conclusion this person is not going to be needed, and now we're going back and just making that adjustment rather than raising it as a whole new point. As if the buyer's first time of hearing it, you can imagine they're going to be thinking, what are we missing here?
Right.
Yeah.
But you think about like the opposite situation. If the buyer came to you after signing the terms of an LOI and was like, actually, I think that you're understaffed and we're going to add a bunch of expense and reduce your valuation, it would be like out of nowhere.
Yeah.
That would not be received well by a seller,
Absolutely. That's a great point.
Yeah.
So like I think it's obviously if you think this person really isn't going to be there, it's perfectly rational that you would want to remove them from the P&L because you don't want to miss the valuation on those dollars. But you really need to be sensitive in how we raise this question. What does this person do in your firm? The buyer is going to be asking, okay, if we let this go, is it going to cause any service issues? I don't know how much capacity this firm has today. You would think if you're down a person, even beyond that, whatever that capacity issue is going to be impacted. And so these are the things running through the buyer's head is like, does the business, how viable is it going forward without this person? Are our service standards going to be the same or not degraded by this person leaving? Is it going to cause disharmony in the office? It's all of these things. And then probably the worst thing that they could think is this owner, do they really care about their team? Because they're from where we sit, because they haven't raised this issue before, maybe they're just trying to cut headcount to increase valuation. That would be received very poorly,
Totally.
So yeah. So unfortunately, like it's a great question and one that we need to be talking about, but the timing of talking about this is before you've signed the LOI. I think it's very important to have these discussions so that there's no negative perception creeping into the mind of the buyer. Do we have a potential partner here who's just all about the money, slashing and burning their team to jack up the evaluation? If it's rooted in stuff that's very real, I think it's perfectly fine to raise it. It's just to be handled with care. So that's my long-winded answer. So.
I like it. Yeah, good.
All right.
All right. Well, that's a wrap.